Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. Turning panic into profits. How simplicity is the key to navigating stormy markets. It's a pretty cliched and tired joke to call every sharp drop in the equity markets either a buying opportunity or a learning experience or both. I know because I do it every single time that the market falls suddenly and sharply. However, I say it with the utmost sincerity because after a few decades of investing, I genuinely believe in this. Every single time the market falls sharply, you will come out of it as a better investor, and if you keep calm, with some good investments made at a good price. The reasons are the oldest ones in investing. The key is to resist the urge to panic and make rash decisions driven by fear. Maintain a long-term perspective and look at the underlying fundamentals of the companies you're invested in. Often, the best buying opportunities arise when the herd is selling indiscriminately. By going against the grain and buying when others are fearful, you can position yourself for potential gains when sanity returns to the markets. However, we all know that this is easier said than done. On the 4th of June, when the Sensex was down 9% at one point, hardly any investor was bravely thinking of buying opportunities. Everyone thought only of how much they would lose and how long the carnage would continue. That's normal, of course. And yet, there were different categories of investors. There were those who were worried and those who were in a blind panic. The worried investors may have felt a knot in their stomachs, but they stayed the course, perhaps even tentatively buying more shares. On the other hand, the panicked investors likely sold off in a frenzy, locking in losses. This distinction is crucial as it often determines who will ultimately benefit when the market recovers. Remember, history has repeatedly shown that those who keep their cool during downturns are often the ones who come out ahead. Sensible, informed investing, grounded in fundamental analysis, tends to weather the storm far better than speculative gambling on market whims. The merely worried were those who had invested sensibly and understood the logic behind their investments, while the panicked were the punters who were betting on rumor and momentum alone. One characteristic that always distinguishes the two types of investors is the simplicity of their investing choices. In stocks as well as mutual funds, there are investments that are easy to understand and whose investment case is obvious. However, simplicity is easy to talk about and difficult to practice. We live in an environment where complexity and features are worshipped. No matter what product or service we buy, we're often most impressed by features, jargon, and complexity. Perhaps our modern technological world has conditioned us to believe that the latest marvels are too intricate for the average person to understand, and therefore, complexity equates to quality. However, in personal finance, this notion is dangerously misguided. When it comes to investments, simplicity isn't just beneficial, it's essential. The reason is straightforward. If an investor doesn't fully comprehend a financial product or service, they can't determine if it's even remotely suitable, no matter how highly touted by the seller. So, how can you ensure you understand everything? The simplest way is to keep things straightforward. Unfortunately, the prevailing message is quite the opposite. When I look at today's market for savings and investment products and the resulting portfolios that people are accumulating, it's evident that there's a pressing need for self-aware and assertive minimalism. When things get tough, those with the basics right, diversification, cost averaging, asset allocation, don't panic. What's important is that an investor should have done all this in their portfolio and be confident that they have done it. And that only comes with simplicity. Embracing simplicity in your investment strategy is not just a defensive move. It's a proactive approach to building a resilient portfolio. By focusing on clear, comprehensible investments, you equip yourself to make informed decisions even in turbulent times. Of course, one hopes the times will not stay turbulent, but it's best to be prepared.